Welcome to Stock Spotlight. I'm your host, Michael. This episode is a little different. Instead of starting with a single company deep dive, I want to use this as the best starting point for anyone new to the podcast. Think of it as the foundation for how I analyze businesses and how I try to build a repeatable investing process. At its core, Stock Spotlight is about finding quality businesses, understanding what actually matters, and using a consistent framework to decide whether a stock belongs on the watch list, in the portfolio, or in the pass pile. That process starts with my 33-question quality checklist. But the checklist is not the final answer. It is the starting point. The real work is taking a business, breaking it down, identifying the handful of variables that drive the outcome, and asking whether the market's expectations make sense. This is not a stock tip podcast. It is not about predicting what happens next week, and it is not about sounding certain on every company, even though I like a lot of them. It is about building a better investing process over time, documenting the work, and making business analysis easier to understand. The reason I started Stock Spotlight is because I wanted a more structured way to think through individual stocks. Like a lot of investors, I had watched plenty of companies, read plenty of commentary, and built opinions over time. But opinions are not a process. A process requires consistency. It requires asking the same kinds of questions across different companies, even when the story is exciting. It requires writing down what you believe, what could go wrong, and what would make you change your mind. That is what this show is trying to do. Each episode takes either a company, a portfolio question, or an investing framework and puts it under the spotlight. The goal is to separate the interesting story from the actual investment case. Sometimes that means a company looks better after the work. Sometimes it means the business is great, but the stock is not attractive enough. And sometimes it means the right answer is simply to pass and move on. A lot of how I think about investing started before I was seriously investing. For most of my life, I played baseball. More specifically, I was a pitcher. When you are a pitcher, a big part of the job is studying hitters. You are trying to understand patterns. What does this hitter chase? What does he ignore? What changes in a 2-0 count versus a 2-1 count? What happens if you show him the same pitch twice? What changes when there are runners on base? Now, you're not looking for certainty, rather, you're looking for small edges. And if you can find enough small edges and repeat them over time, they start to matter. That is very similar to how I think about investing now. I am not trying to know everything. I am trying to understand the most important variables better than I did before. What really drives this business? What is the market rewarding? What is the market ignoring? Where are the incentives? What would have to go right and what would have to go wrong? My professional background is also not traditional finance. I come from customer insights where the work is about understanding how people make decisions, what they respond to, what they ignore, and how incentives shape behavior. That has influenced how I study companies. Investing is not just reading financial statements. It is also understanding customers, competitors, management teams, industry structure, and behavior. The center of gravity for Stock Spotlight is still individual company deep dives. Most of the time, I am looking at a business through my 33-question quality checklist and then deciding whether the company deserves more research, a spot on the watch list, or a pass. But the show has also expanded beyond individual stock research, and that is intentional. Individual stock picking does not exist in isolation. A stock can be high quality and still be the wrong fit for a portfolio. A company can have an excellent business model, but still be priced for too much perfection. A strategy can look smart in theory, but still difficult to hold in real life. So along with company deep dives, I also cover portfolio construction, portfolio analysis, factor investing, risk management, beginner topics, and guest interviews. The common thread is process. How do you analyze a business? How do you decide what matters? How do you compare quality versus valuation? How do you size positions? How do you avoid turning every interesting company into a buy, which is one of my problems that I'm working on? Those are the questions I want the show to keep coming back to. The goal is to build a better process by studying the right businesses and asking better questions at the portfolio level. My individual stock philosophy is mostly quality growth. I am looking for businesses that can compound over long periods of time. To me, that usually means companies with durable revenue growth, free cash flow per share growth, strong returns on incremental capital, disciplined capital allocation, and some kind of competitive advantage. But quality can become a vague word, so I try to define it more clearly. A quality business should be understandable. It should have attractive unit economics. It should have room to reinvest. It should have management that allocates capital well. It should have a balance sheet that gives the company flexibility. And it should have a thesis that can be monitored through a few key metrics. I am also trying to avoid the mistake of confusing a great product with a great stock. A company can have loyal customers and still be a bad investment at the wrong price. A company can grow revenue and still destroy value if the economics do not work. A business can look dominant today and still have a weaker long-term moat than the market assumes. That is why the question is not simply, is this a good company? The better question is, what has to be true for this to be a good investment from here? The foundation of my process is a 33-question checklist. The checklist evaluates companies across categories like fundamentals, management, industry position, efficiency, momentum, growth, valuation, capital allocation, solvency, and liquidity. The main benefit is consistency. It forces me to ask similar questions across different companies. That matters because without structure, it is easy to fall in love with the narrative. It is easy to overweight the exciting part of a business and underweight the boring but important parts. It is easy to confuse momentum with durability. It is easy to confuse a company that I like with a stock that I should own. The checklist helps me slow that down, but I do not want it to become overly mechanical either. A company does not become a buy just because it scores well, especially if it's a cyclical, and a company does not automatically become a pass because it has a few weak spots. Great example here is Axon. Rather, the checklist is a filter. It helps identify what deserves deeper research. Then the real analysis begins. From there, I want to reduce the company down to the variables that matter most. In some businesses, that might be retention. In others, it might be same-store sales, customer acquisition cost, utilization, pricing power, operating leverage, returns on capital, or capital intensity. Every business has a few key variables that matter more than the rest. Our goal as investors is to find them. Valuation is another major part of the process, but I try to be practical about it. My view is that valuation matters, but the way it matters depends on the time horizon. Over short periods, valuation can dominate returns. Over long periods, business performance usually matters more. That does not mean price is irrelevant. It means I want to understand what expectations are already embedded in the price. That is why I like reverse DCFs. Instead of pretending I know the exact fair value of a company, a reverse DCF asks a different question. What does the market already believe? What level of growth is priced in? What margin profile is being assumed? How much free cash flow does the business need to generate? And do those assumptions look reasonable based on the company's history, reinvestment opportunity, and competitive position? I also look at traditional DCFs, forward free cash flow yield, owner earnings yield, historical multiples, forward multiples, and valuation relative to the company's own and competitive history. The goal with all of this is not false precision. It is better understanding. If the market is pricing in heroic assumptions, I want to know that. If the market is pricing in reasonable assumptions for a truly exceptional business, I also want to know that too. One thing that has become clear to me over time is that stock analysis and portfolio construction have to work together. My portfolio is not just individual stocks. It combines broad market exposure, factor tilts, diversifying strategies like managed futures and gold, and a sleeve of individual equities. That structure affects how I think about position sizing. I am not trying to own every stock I like. I am trying to own a portfolio that balances long-term compounding, diversification, and behavior. Within the individual equity sleeve, I want my best ideas to matter. That means larger position sizes for companies where I have more conviction in the business quality, resilience, and long-term opportunity. But I also want lower conviction names to stay smaller. The worst version of stock picking is when your biggest losses are in names you never fully understood and your best ideas are too small to matter. That is why I care about a watch list, position sizing, sell discipline, thesis tracking, and knowing what would cause me to add, trim, hold, or exit. I also created the Stock Spotlight Substack as a written extension of the podcast. Some things are easier to explain in writing than in audio or video format. The podcast is useful for talking through a company or a concept, but the Substack gives me a place to document the research more clearly, show the math, explain valuation assumptions, and organize the frameworks behind the episodes. Some posts build on podcast episodes, others are focused on valuation breakdowns, checklist screens, investment memos, investing frameworks, and portfolio updates. The goal across both platforms is the same. Take something complex and make it clear. I want Stock Spotlight to become a library of investing research and business analysis that improves over time. If you are new here, Stock Spotlight is for long-term investors who like individual stocks but do not want to rely only on narratives. It is for people who enjoy business analysis but also care about valuation, portfolio construction, and risk management. It is not financial advice, and I will be wrong plenty of times. But I think there is value in showing the work. There is value in writing down the thesis. And there is value in tracking what changed. Thanks for listening to Stock Spotlight. I'm your host, Michael, and I'll see you in the next episode.